The S&P 500 has delivered an average of 10.2% per year for nearly a century. Warren Buffett publicly said it is the best investment most people can make. And for most of your investing life, he is right. But at a specific point, a number I'm going to give you in exact terms, the S&P 500 quietly stops being your best tool and starts being the thing most likely to derail everything you built. Not because the market turns bad, because the math of your relationship with it changes completely, and most people never notice until it's too late. As of May 2026, the Shiller-Cape ratio, the most reliable long-term valuation metric we have, is at 39.9. That is the highest reading since 2000. A CAPE above 40 has only been recorded twice in history. The first time was at the dot-com peak in December 1999, when it hit 44.19, right before the index lost roughly half its value over the following 2.5 years. The second time is right now. And here's the part that will actually change how you think about your portfolio. The number I keep coming back to isn't a CAPE ratio. It's not a market cap or a stock ticker. It's a dollar amount that lives inside your own brokerage account. And once your balance crosses that threshold, the rules of the game silently flip. That threshold is somewhere between $300,000 and $600,000, depending on your expenses. I am going to show you exactly how to calculate it for yourself. More importantly, I'm going to explain the 3 separate reasons why the S&P 500 stops being your best option at that size, and none of them are the reasons you've probably heard before. Let me explain what I mean by the rules flipping. Right now, if you're accumulating wealth and contributing regularly to your index fund, market drops are mathematically good for you. A crash means you buy more shares at lower prices. The sequence of returns actually works in your favor. The S&P 500's average annual return has been about 10% since its launch in 1957, and over the past 40 years, it stands at 11.5%. Those numbers are real. But they're real for accumulators, people adding money every month, not people living off the portfolio. Here's the central idea of this video, and I want you to hold on to it like a thread through a maze. The S&P 500 is a rocket. It is absolutely the correct vehicle for launch. It gets you off the ground faster than almost anything else with almost zero maintenance, and it is brutally efficient on the way up. But here's the thing about rockets. You do not land a rocket the way you launched it. The physics change entirely, and the investors who figure that out early enough end up in orbit. The ones who don't, well, I'll tell you what happens to them in about 4 minutes. Before I get there, I want to set up something that's going to run through the rest of this video. There's a story about the S&P 500 that most people believe, and I'm going to tell you why it's half right and why the half that's wrong is the half that will cost you the most money at the worst possible moment. The story goes, the S&P 500 represents 500 of the largest companies in America, spreading your risk across industries, sectors, geographies, broad diversification. Sleep well at night. Buffett said so. Done. The problem is that this story hasn't been true for years, and the gap between what people think they're holding and what they're actually holding has never been wider. In a few minutes, I'm going to show you what happened to a specific retiree in 2000 who had $1 million S&P 500 portfolio and a perfectly reasonable withdrawal plan. But first, here's why the index itself is even more broken than you probably think. By the end of 2025, the 10 largest companies in the S&P 500 accounted for nearly 41% of the index's total weight, more than doubling in just 10 years. Think about that for a second. You think you own 500 companies, but 41 cents of every dollar you put into an S&P 500 fund goes to 10 names. The index's effective N, a statistical measure of how many stocks are truly driving performance, is 54. The index behaves as if it had 54 equally weighted stocks, despite officially holding 503. So you don't own a diversified basket of American business. You own a highly concentrated bet on 54 companies, with the top 10 doing most of the heavy lifting. And right now, those top 10 are overwhelmingly in the same sector, tied to the same narrative. Unlike past periods when the top 10 spanned unrelated industries, Today's leaders are closely linked by a common theme: AI. That effectively turns the index into a directional bet on AI adoption and monetization. If expectations slip or timelines extend, there are fewer offsetting exposures within the index to absorb the impact. 5 stocks: NVIDIA, Alphabet, Broadcom, Microsoft, and Apple accounted for 45% of the index's returns in 2025 alone. 5 stocks, not 500. Now here's the thing. The bulls have a reasonable counter to this. They'll say the fundamentals of these companies actually justify the concentration. They're profitable, they generate massive cash flow, they have durable advantages. Unlike previous periods of market concentration, the current top 10 are supported by strong fundamentals. Accompanying the increase in market concentration has been a rise in earnings concentration, as these companies' share of earnings has also increased significantly, from about 20% of overall index earnings in 2015, rising to about 30% today. That's a fair point. But here's the reversal. You don't think the problem is that these companies are bad. They're not. The problem is that their market cap weight is running about 10 percentage points ahead of their earnings share. In 2025, the top 10 stocks represented roughly 41% of the index's total weight, but were expected to generate only about 32% of its earnings. That gap has widened meaningfully since 2015, when weight and earnings contribution were more closely aligned. While the largest companies remain highly profitable, market value concentration has increasingly run ahead of fundamental profitability. That gap is where risk lives. Not in the companies being bad in the market, pricing them beyond what the fundamentals can justify in a single bad quarter. The top 10 S&P 500 stocks now account for nearly half of the total volatility in the index. You're holding something that says 500 companies on the label, but delivers the risk profile of a highly concentrated tech portfolio. In every decade, certain sectors or companies have risen to dominance, only to eventually lose their footing. In the 70s and 80s, the top of the S&P 500 was filled with industrial and energy giants like IBM and ExxonMobil. By the late 90s, the baton had passed to technology stocks, culminating in the dot-com bubble. The 2000s saw value stocks and financials rise, only to be undone by the 2008 financial crisis. Now, once again, there is a surge in concentration, this time led by the Magnificent Seven. This is a comedy of errors that repeats on a 20-year loop, and every generation thinks their version is the one time it won't reverse. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Now stay with me, because this next part is where the math gets genuinely unfair, and this is the actual reason the rocket metaphor matters. The concentration problem I just described is dangerous for everyone. But there's a second problem that only becomes deadly after your portfolio crosses a certain size, and this is the one that has actually destroyed retirement plans for real people in real time using a real index fund they thought was safe. It's called sequence of returns risk, and it is the most underestimated financial threat in the entire universe of personal finance. Here's the idea. When you're accumulating wealth, the order in which you receive your returns doesn't matter. A 50% crash followed by a 100% recovery leaves you with the same balance as a 100% gain followed by a 50% crash. The math is symmetric. A $1 million portfolio that experiences returns of negative 50% and then positive 100% finishes with the same balance as a portfolio that has returns of positive 100% and then negative 50%. Both portfolios finish with the same $1 million they started with. Order doesn't matter when there are no cash flows. But the moment you start withdrawing money to live on, to supplement Social Security, to fund the retirement you spent 30 years building, order matters enormously. In retirement, the order in which returns occur can be just as important as the returns themselves. Experiencing negative market years early on, while taking withdrawals, can significantly shorten the lifespan of a portfolio. Let me tell you about a man I'll call Richard. He's not a reckless guy. He doesn't trade options. He's been dollar cost averaging into an S&P 500 index fund for 25 years. January 2000, he retires at 62 with $1 million. His plan is textbook. Withdraw $40,000 a year, adjusted for inflation. 4% rule. Bulletproof, right? The S&P 500 drops 49% between 2000 and 2002, then it partially recovers. Then 2008 hits, and the index drops another 57% from its peak. The S&P 500, which had averaged more than 10% annualized returns before 2000, instead delivered less than average returns from the start of the decade to the end. Annualized returns for the S&P 500 during that market period were negative 0.95%. Negative. For a decade. An investment of $100,000 in the S&P 500 on the eve of Y2K was worth $90,934 at the end of 2009. Now here's what happens to Richard. His portfolio starts at $1 million. He withdraws $40,000 annually adjusted for inflation. By the end of the lost decade, in 2009, his portfolio had dropped to $455,000. Even by the end of 2019, after the strong recovery, it remained below $400,000. He ran out of money entirely by 2017. 17 years into a retirement funded by the most broadly held, most trusted investment vehicle in American history, gone. And here's the brutal part. If you need $50,000 a year from a $1 million portfolio and it drops to $850,000 in year one, your withdrawal rate rises from 5% to nearly 6%. This can accelerate portfolio depletion unless offset by new contributions, higher returns, or reduced spending. You're forced to sell more shares at the worst possible time, permanently reducing the number of shares that can participate in the eventual recovery. This is the mathematical ratchet that Richard couldn't escape. Now, here's the reversal everyone misses. The diversified portfolio in the same study, one that held small cap value, international equities, real assets, alongside the S&P 500, did something completely different during that same decade. That portfolio maintained exposure to the S&P 500, but also included US, small cap value stocks, and other diversifiers. At the end of the lost decade, it had grown to $1.2 million, despite annual withdrawals. By the end of 2019, it had grown to $1.9 million, significantly outperforming. Same starting point. Same withdrawal amount. One portfolio empty, the other doubled. The difference wasn't genius stock picking. It wasn't even dramatically better returns over the full period. It was the absence of catastrophic correlation, the fact that when US large cap technology collapsed, other parts of the portfolio held their ground. During the lost decade, international small cap stocks alone delivered a total return of over 190%. You think the problem is that your S&P 500 might go down. The actual problem is that it might go down at exactly the wrong moment when you need to start selling, and that it might drag all of your exposure down at once because it has quietly become one sector masquerading as an index. That is the sequence problem, and it only becomes existential once your portfolio is large enough to be your primary income source. Morningstar's 2025 research confirmed that retirees who experienced poor returns in the first 5 years and did not adjust their spending were far more likely to go broke. This is sequence of returns risk in action, and it is the single biggest threat to any retirement withdrawal plan, regardless of the starting rate. Now, here is the exact math for where the line sits for you personally. Take your expected annual spending in retirement. Multiply it by 25. That's the number most financial models use as the minimum portfolio size at a 4% withdrawal rate. But here's the thing those models don't tell you. At a CAPE ratio of nearly 40, which is where we sit right now, the expected forward real return on the S&P 500 over the next 10 years is materially lower than the historical average. What the CAPE data suggests, with reasonable statistical confidence, is that the central estimate for the next decade is materially lower than the long-run S&P 500 average of roughly 7% real, which means the cushion built into the 4% rule evaporates. So the threshold isn't when you hit $1 million, it's earlier than that. It's the moment when your portfolio can generate meaningful income, and a 2-year crash multiplied by your portfolio size equals more than 5 years of your living expenses. For most of the audience watching this, that number lands somewhere between $350,000 and $600,000. That's the exact window where the rocket needs to change its flight plan. Here's where knowing the number and building a system around them are two very different things. I had this data in my hands years before. It changed how I actually invested. The problem wasn't information. It was that I didn't have a framework that connected the math to a decision. So I built one. I wrote a digital book called The Exit Code. It's 8 chapters of pure retirement data research, 50 years of historical patterns distilled into a mathematical framework for figuring out your actual exit date from the rat race. I want to highlight 2 things from it that connect directly to what we've been discussing. The first is what I call the 58% rule. Studies show that a specific percentage of Americans are forced out of their careers before their planned retirement date, not because they chose to, but because of health, layoffs, or caregiving. When that happens to someone who is 100% in the S&P 500 with no buffer, the sequence risk I just described hits them at the worst possible moment, when they've just lost their income and are suddenly forced to draw down a portfolio that may be down 40%. The exit code includes the exact buffer calculation that protects against that scenario. The second element is what I call the 4% trap and the dynamic withdrawal method that replaces it. The 4% rule was built on historical data that assumed a CAPE ratio near the long-run average. At a CAPE near 40, the math changes. The book shows you the modified withdrawal rate that keeps your portfolio solvent across market scenarios that the original rule would fail. You can get it for less than dinner out through the link in the description. Every year you wait on this compounds against you, not as a marketing line, but as a mathematical fact. Now, let me tell you the third reason the S&P 500 stops being your best investment after a certain size. And this one is even more insidious because it's invisible on your brokerage statement. Since investors are subject to taxes in the year income is received or gains are realized, even if the proceeds are reinvested, this ongoing taxation creates what's often called tax drag, reducing how much of your return stays invested and compounding over time. Here's the specific math. The S&P 500, as of right now, yields roughly 1.3% in dividends annually. On a portfolio of $500,000, that's $6,500 in dividend income every year, automatically taxed in a standard brokerage account. Not a big deal, right? Wrong. Because high-earning individuals also need to account for the net investment income tax, an additional 3.8% tax that can be triggered if your income exceeds a certain limit. For a single filer with income above $533,400, long-term capital gains are taxed at the 20% rate, and with the NIIT added, that total hits 23.8%. 23.8% of your dividends gone every year, automatically, without any transaction on your part. And as your portfolio grows, the dividends grow. A $1.5 million portfolio at the same yield generates almost $20,000 in annual dividend income, nearly $5,000 of which goes to taxes before you see a cent of it. Now you might be thinking, that's still a small percentage of your overall return. But compound the damage. Every dollar that goes to the IRS in taxes is a dollar not compounding at 10% annually. Over 30 years, a 1% annual tax drag on $500,000 costs you approximately $170,000 in lost compounding. That is not a rounding error. That is a car, a year of college, or $18,000 a year in additional retirement income. Here's the reversal. You think the problem is market volatility. The actual problem for someone with a large taxable portfolio is the silent recurring tax bill that never shows up dramatically but grinds down your compounding relentlessly across every single year. A higher volatility, lower dividend investment structure that you control can actually produce more after-tax wealth than a smooth, dividend-yielding S&P 500 fund, not because the returns are higher in absolute terms, but because more of the gains are deferred and grow unmolested until you choose to realize them. This is where asset location becomes as important as asset allocation. Tax-advantaged accounts, your 401k, your IRA, your Roth, are where dividend-heavy, high-turnover assets belong. Taxable brokerage accounts are where you want assets that appreciate without generating ongoing taxable income. The S&P 500 inches a taxable account is not the worst thing in the world, but it's also not the most tax-efficient structure once you're generating meaningful income from it. Now, Let me bring in the subplot that has been running quietly underneath everything I've said so far. Because there's an extremely famous piece of financial advice that is almost universally misquoted. And the misquote is, costing people real money. Warren Buffett has said that an S&P 500 index fund is the best investment most people can make. In fact, he stated that he wants the majority of the money he'll leave to his wife to be invested in such a fund after he's gone. The internet turned this into, Buffett says, put everything in the S&P 500. And that is not even close to what he said. He said the majority of the money left for his wife. Not all of it. Not money she might need in 5 years. Not money being withdrawn actively. Money left over after her needs are otherwise covered, invested passively for the very long run. There is a meaningful bond allocation in that same plan. His wife was not going to be withdrawing 4% annually from a 100% equity portfolio during her 80s while the market oscillates between meltdowns. The sequence risk that would destroy that plan is exactly the scenario Buffett designed around. He just never explained it in the quote, and the finance media stripped all the nuance out to make a cleaner headline. Buffett knows the rocket metaphor. He doesn't launch the same vehicle twice. Now we need to talk about what actually comes after the S&P 500. And this is where it gets really interesting. The current CAPE ratio of 39.9 is 77% above its long-term trend line. Historically, levels of high concentration lead to poor forward returns. The worse the concentration, the worse the returns. Current levels of concentration suggest a forward return on the S&P 500 index of -5%. Goldman Sachs research. As of September 2025, -5% expected forward return. Now, that's one projection, and projections are wrong all the time. But the direction of the signal matters, even if the exact number doesn't. At a CAPE near 40, you are sitting in one of the two most expensive moments in 140 years of market history to be buying the S&P 500 at full weight. The other time was December 1999. Here is the framework I use for thinking about what to do with this. I call it the 3 floors of portfolio evolution, and it maps to the amount of capital you actually have. Floor 1, below $200,000. At this level, simplicity wins almost every time. The S&P 500 is your best friend. The benefit of low-cost, broad exposure to American business compounds freely. You're in accumulation mode. The sequence risk I described earlier isn't existential, and the transaction costs and cognitive overhead of adding complexity reduce your returns. Get in, automate contributions, go live your life. The rocket is on the launch pad, point it up. Floor 2, $200,000 to $600,000. This is the transition zone. Sequence risk is beginning to matter. Tax drag is beginning to compound meaningfully. Your portfolio is large enough that a concentration problem in the index could cause real damage, but not yet large enough that you have access to many institutional tools. At this floor, adding a small cap value tilt historically, one of the most well-documented sources of excess return in the academic literature, improves your risk-adjusted outcome significantly. A moderate international allocation that gives you exposure when US large cap enters a down cycle is also worth holding, even though it has underperformed for a decade. Diversification frequently costs you in the good times and earns you everything in the bad times. The rocket has cleared the atmosphere. You need to start thinking about orbital mechanics. Floor 3, above $600,000, approaching and beyond $1 million. At this level, the tax conversation dominates. Asset location, tax-efficient asset class selection, and genuine diversification across uncorrelated return sources become the difference between compounding aggressively and quietly handing a large portion of your gains to the government. At this floor, real estate investment trusts belong in your tax-advantaged accounts. REITs outperform stocks over the last 25 years, with the FTSE Nareit All-Equity REIT Index delivering an average annual total return of 10.8% compared to 10.3% for the S&P 500. Several studies have found that an optimal portfolio will include a 5 to 15% allocation to REITs, international developed market equities, which are currently trading at a substantial discount to US, Valuations on any cyclical measure belong in your taxable account where their foreign tax credits are actually usable. Let me show you how this plays out with a real scenario. David is 48 years old. He has been a diligent saver his entire career. His 401k holds $520,000, all in an S&P 500 index fund. His taxable brokerage account holds $230,000, also in the S&P 500. Total portfolio, $750,000. He plans to retire at 62. His expected annual spending in retirement is $75,000. He needs $1.875 million to retire at a 4% withdrawal rate. Now, here's where David's plan has a hidden problem. He has 14 years until retirement. If markets deliver the historical 10% average, he gets there easily. But at a CAPE of 39.9, high CAPE has historically been linked to lower forward 10-year real returns. If the next decade looks anything like 2000 through 2009, and the structural setup is currently more similar than most people are comfortable admitting, David's $750,000 might be worth less in nominal terms in 10 years than it is today, just as he is entering the highest stakes years of his transition to retirement. The sequence problem for David isn't just theoretical. At 60, if he's laid off, and Morningstar's 2025 research found that retirees who experienced poor returns in the first 5 years and did not adjust their spending were far more likely to go broke. He faces a scenario where he is simultaneously losing income and potentially watching a concentrated index decline sharply. The rocket is coming back into the atmosphere without a heat shield. What David should do right now, move 60% of his 401k into a diversified portfolio that includes small cap value and international allocation. Keep the S&P 500 as the core, but reduce it from 100% to 60% of total equity exposure. In his taxable account, stop adding to the standard S&P 500 fund and begin buying growth-oriented, low-dividend assets that defer capital gains. Run 1 year of living expenses in cash. As a sequence buffer, the psychological value alone is worth something, and the financial math shows that maintaining a cash reserve allows you to avoid selling depressed equities in a downturn. Over 14 years, these changes don't dramatically reduce his expected return in good scenarios, but in a bad scenario, they are the difference between retiring on time and working until 68. At this point, I want to give you 2 moments of honesty before the takeaways. First honest moment. Your financial advisor, if you have one, almost certainly has you in something close to 100% S&P 500 exposure if you're under 50 and in accumulation mode. That advice is not wrong for someone with $100,000. It becomes increasingly incomplete as your balance grows. They don't usually have the conversation with you about the transition until you're already in it, by which point it's late. Second honest moment. The S&P 500's last 3 years have been extraordinary. The S&P 500 surged 14.28% in 2025, its 3rd consecutive year of double-digit gains. In 2025, the index added approximately 17.7% in total return terms. 3 years of double-digit returns in a row trains your brain to believe the acceleration is the default state. It is not. The S&P 500 has had negative returns in 25 out of 97 years of data. It had negative returns in 4 separate calendar years between 2000 and 2008 alone. The recent performance is a reason to feel good about past decisions. It is not a prediction. The one question I get asked most often is, if the S&P 500 has a lost decade starting now, what do I own instead? The short answer is not instead of. The S&P 500 stays in the portfolio. It just stops being all of the portfolio. Here are your 3 specific takeaways. First, calculate your sequence risk threshold right now. Multiply your expected annual retirement spending by 25. If your current portfolio is more than 50% of that number, you are inside the window where sequence risk can be existential. Today, not when you retire. The mitigation starts now, because the correction that damages you most is the one that happens while you're still thinking about it. Second, Build the 3-asset diversification structure. Keep your S&P 500 core, but add a meaningful tilt to small cap value, historically one of the highest factor premia in academic finance, and almost perfectly uncorrelated to the AI concentration risk sitting in the current index. Add 15 to 20% international developed market exposure. Not because international will always outperform, but because when US large cap enters a lost decade, the global diversification means you don't lose everything at once. The equal-weighted S&P 500 during the lost decade posted an annualized total return of 5.1%, while a dollar invested in the cap-weighted index at the end of 1999 declined to 91 cents. By the end of 2009, a dollar invested in the equal-weighted index would have grown to $1.64. The same 500 companies, different weights, entirely different outcome. Third, act on tax location before you act on tax harvesting. Most people focus on tax loss harvesting as their primary tax strategy. The bigger lever is making sure you hold dividend-heavy, high turnover assets inside your 401k and Roth, and hold growth-oriented, low dividend assets in your taxable account. Two investors with the same portfolio and the same returns can end up with very different results depending on how their accounts are structured and subject to taxes. That gap is not a small rounding error. Over 30 years, it compounds into a meaningful portion of your final wealth. The reason most people don't make these adjustments is psychological. The S&P 500 has worked. Changing it feels like fixing something that isn't broken. But that's exactly the cognitive trap. You don't adjust a portfolio because something is broken. You adjust it because the math of your relationship with that portfolio has changed. The same vehicle that got you here is not automatically the correct vehicle for the next leg. Knowing when the physics change and adapting before the market forces you to is the entire game. Lazy investing built more fortune than crypto memes. And the laziest, most compounding move you can make right now isn't to find the next hot sector or rotate dramatically out of US equities. It's to spend 45 minutes doing the threshold calculation I described, running your numbers through the 3-floor framework, and making 3 quiet adjustments to a portfolio you then leave mostly alone for years. The rocket doesn't need to be replaced. It needs a second stage. Most investors never bother to install it. Note, this script cites data as found in publicly available research sources, including Guinness Global Investors, August 2025, RBC Wealth Management, December 2025, AHE Signals ACRI Composite, April 2026, Advisor Perspectives, Robert Schiller CAPE Data, May 2026, Morningstar Retirement Research, 2025, Goldman Sachs Investment Research, September 2025, Dimensional Fund Advisors, Historical Return Data, Fidelity, Historical S&P 500 Data, and Peerford FP, Spark Wealth Advisors Backtesting Data. All figures are as reported and should not be taken as investment advice.